Hi everyone, welcome to our DAT IQ Weekly Market Update. This is our update for July the 1st. This is our first show of July, episode 298. I'm Dean Croak, Market Analyst here at DAT, along with co-host Chad Kennedy. I'm sitting in for Ken Adamo. With special guest, welcome back to the show, Dustin Jalbert from Fast Markets. Dustin, good to have you back. It's been quite a while.
Yeah, thanks, Dean. It's always a pleasure to be on the show. It's obviously it's also really timely here because there's a lot of sort of press on the lumber market that's coming to sort of on the tape here. So it's a good timing to chat about wood products and housing. So
tell us a bit about what you do at Fast Markets for those that haven't met you before.
Yeah, so I've worked with Fast Markets and RISI kind of for almost a decade now. I work as a business economist covering the wood products market. Specifically, my area of specialty is the softwood lumber space. And so I've been covering lumber for about 5 years now. So obviously it's been a very eventful market the last, over that period, given all the pandemic disruptions and things like that. So and I'm our lead author for the sort of lumber commentary, which is our monthly kind of outlook for the softwood lumber market.
Great. Well, good to have you with us. Chad, how's things down in Florida?
Yeah, things are good. Watching out for the hurricanes coming through the Atlantic, but it looks like we're clear so far. But rates are starting to trend up a little bit in the spot shipper area. So we'll report on that in a bit.
Yeah, I just had a call from a journalist this morning wondering about Hurricane Beryl's impact, and I said if it's too far south, maybe they'll start to move some oil rigs in the Gulf. So we might see an impact on Gulf production, but not so much on freight markets. It looks like it's too far south. All right, Dustin, we'll bring you back in a little bit later. Let's get into the market update. Remember those that are new to the show here, drop your questions into the chat section. We'll get those to you later in the show. The long form version of today's market update will be available at dat.com/market update tonight, along with the charts and accompanying commentary. So let's start with some of the key trends we're watching this week. Demand pretty much followed seasonal trends. It was the last full shipping week of the month before July 4 this Thursday. Spot rates were up slightly. Reefer rates surprised a little bit, remaining mostly unchanged. It looks like they've already peaked, which is a little bit early, but this is a short work week. So most of the shipping volume could have occurred last week. Shipping volumes, produce volumes are down about 4% week over week at a time of the year when the week over week gain is usually double that number. Some news from Canada. The Canadian General Freight Index, the CGFI, indicates the total cost of ground transportation for Canadian shippers was up 1.8% in April compared to March, but down about 5.25% lower than last year when you take out fuel, and also about 9% lower than the August 2022 peak. So contract rates in Canada dropping about 5.25% year over year. Beryl weakened to a Cat 3 hurricane. We're still watching that pretty closely as it gets into the Gulf. But Hurricane Beryl's arrival as a Cat 4 was exceptionally early to the hurricane season. On Sunday, it was ranked as a Category 4 hurricane in the Atlantic Ocean, and it's only it's the first time, in fact, a Category 4 hurricane has been recorded in the month of June. Remember from previous shows, forecasters are predicting 20 to 25 named storms this year, so we're already off to a pretty interesting start there. Of course, it's grilling season. National Hot Dog Month is July. We'll consume about 7 billion hot dogs, or 16,300 reefer loads during hot dog season. So we expect a little bit of demand on the reefer side there. Lumber prices, which is a really good topic for today's guest with Dustin. Lumber prices have tumbled about 27% since March. Dimension framing lumber in particular, which a lot of flatbed carriers haul, prices are falling. So we'll dive into that a little bit later with Dustin. In this week's market update that'll be out this evening, we're talking about cold storage inventory for proteins that are impacting reefer carriers. The ATA tonnage index is out. We've got some data on avocado season. And more importantly, for flatbed carriers and brokers, farm tractor sales are about 30% lower than the 5-year average. Amidst a slew of OEM layoffs in the agricultural space, farm incomes are expected to drop about 25% this year. So decreasing crop prices, increased borrowing expenses, all of those are having an impact on flatbed volumes, especially for flatbed carriers. So let's start off our market update with the load to truck ratio for dry van. Load post volumes followed the typical pre-July 4 surge in freight volumes. They were up 13% last week. That's identical to the average pre-July 4 surge over the last 8 years. So seeing a pretty solid seasonality there. Volumes are about 3% higher than last year. Equipment posts, were down. So the load to truck ratio was at 5.66. That's the third highest reading for this time of the year in the last 8 years. In the refrigerated market, even though reefer load post volumes were up last week, they're still about 7% lower than last year, obviously dragged down by much lower produce volumes. The Georgia season's coming online. The national produce season, is down when you look at national numbers, but some of the regional seasons like Georgia, volumes are up 1% year over year, are being dragged down by states like California, who produce about 33% of our volume. Produce volumes are down about 6% last week. Mexico is even down further, down almost 30% year over year. Load to truck ratio on reefer, down last week to 8.74. And in flatbed, load post volumes were mainly flat last week, also identical to this time last year, but still the second lowest since 2017. Load to truck ratio unchanged at 13.73 loads per truck. So now moving over to the year over year look at spot rates in the dry van sector. The national average dry van line haul rate, remember folks, these are excluding fuel, line haul only, was up by just under a penny per mile to $1.70 last week. That's the highest dry van spot rates have been since the mid-January polar vortex event. Compared to last year's spot rates are within a penny per mile on a 6% higher volume of loads moved in week 26. DAT's top 50 lanes, based on the volume of loads moved, up 3 cents a mile last week, averaging 206. That's 36 cents a mile higher than the national average. In the refrigerated year-over-year look at spot rates, the national average was flat last week at 203, underlining the softness that we just reported in the produce market. Normally rates are heading north at a fairly good clip this time of the year. They started to flatten out last week. At this rate, line haul rates are sitting identical to last year on a 3% higher volume of loads moved. And lastly, in flatbed, after dropping 2 cents a mile the week prior, flatbed spot rates regained some lost ground last week, increasing a penny per mile, sitting at about 208. The national average flatbed rate is 5 cents a mile higher than last year. Volumes of loads moved are about 9% higher for week 26. So let's have a look at our forecast, starting off with a general look at the color coding there for those new to the show. These are our short-term forecasts. They go out 35 days from today. The blue line is the rolling 7-day weighted moving average of historical rates for loads moved over 550 miles. So these are long haul, excluding fuel, line haul only forecasts. Our flagship model is RateCast. It's in all of our products. It's the green line. Red is the short-term model. It more heavily weights data seen more recently, whereas the green RateCast model weights seasonality a little bit more heavily. And then you've got the yellow and grey blends of the green and red, RateCast and short-term in varying degrees and mixtures. So let's start off with dry van. The RateCast forecast has got rates basically flat through Thursday this week. They dropped down about 2 cents a mile by the middle of July, and then flat through the end of the month from where they are today. Short-term model is a little bit more optimistic, but we're not talking about big movements in numbers here. Fairly consistent model agreement, I think. Rates are going to be flat pretty much, I think, from here on in towards the end of the year, albeit with some ups and downs around some of the key holiday events. So I think RateCast, again, is pretty accurate here, but rates basically flat through the end of July into early August. And in refrigerated, it's reflecting seasonality. We're already expecting a 2 cent per mile drop in reefer rates. Again, we think the rates may have peaked a little bit earlier this year, peaking last week, down 2 cents a mile by this Thursday, and then dropping 4 cents a mile by the time we get out to the first week of August. Again, that shouldn't be a surprise to anybody. That's normally how seasonality works, although it's a little bit earlier than what I would have expected for the July 4 seasonal peak. And in flatbed, as you can see, very strong model agreement. Rates are heading down at a fairly good clip. 8 cents a mile between now and August 3 is the expected drop on all of our model ensembles. Rates drop typically between now and the end of September in the order of about 30 cents a mile. So this is no surprise that we're seeing this happen. Although when you listen to what Dustin's got to say towards the back end of our show about what's happening in the lumber market, he may be able to put some context around why we think flatbed carriers are in for a rougher year than what we might normally see in the back half of the year. So that brings us to Chad's section. Chad's going to talk a little bit about what he's seeing in the.
Yeah, thanks, Dean. So everything that Dean's covered so far has been the view from the broker to the carrier, from our load to truck ratio data from our load board, and then those spot rates from brokers to carriers. So this will be a focus on the shipper view. So the blue and yellow graph here shows the mix of contract rates and spot rates going back to 2016 to current. So you can see that recently, if you were to zoom in on the far right yellow spike there's been a bit of spike in spot rates. So we've talked about this continuing ratcheting up through multiple troughs in the market of shippers using spot more and more. But we're starting to see what might be some supply and demand impact on that. And we're also seeing in the spot premium ratio, which is that black trend line, several data points trending up. So we're at -7%. And what this means is that spot rates are 7% below contract rates right now. Still signaling a soft market. We will watch that to see if it does tip over into the positive territory, which could be a signal of the market tightening. Or as we've talked about in the past, we could see a prolonged equilibrium in the market like we saw in 2016. It is notable here that the black trend line there has been depressed, deflationary spot rates below contract rates for 27 months now. So continuing to stretch out, looking back to the 2019 trough in the market, only 18 months. So significant period of depressed spot rates below contract rates. So that's a wrap on dry van. So we'll go over to temp control next. Temp control, similar types of trends. You can see the spot mix in yellow there starting to trend up as we enter into July. And then the spot premium ratio trending up as well. So that spot mix is at 15%, a little hard to see there. And then the spot premium ratio is at -9%, but trending up. And then on to flatbed. Flatbed utilizing much more spot in general, 42% mix of spot. This is typically because of inconsistent lanes, flatbed shipping out to short-term locations like building sites, that sort of thing. So 42% and a recent trend up in that spot mix trend, and spot premium ratio, slight tick up, but still -5%. So that's a wrap on the shipper side.
For the show about RFP season. So when this is, I think you said March, April was when a lot of RFPs get awarded to carriers. How does that impact rates as large amounts of RFPs are awarded and those rates come into routing guides?
Yeah, great question. So as those contract rates come in, actually those awards start back, that bid cycle starts back in September, October. It's quite a long process. So those awards are made in December, January. For the most part, there's a wide variety of these types of schedules, but we do see the bulk of the awards get executed on in March and April. We are seeing decreased contract rates through that period, March and April. What we measure a metric called new rate differential. We'll probably bring that back in next week. I think we covered it last week if you want to go back and look at that. So we are seeing that new rates are still coming in from those bids lower. It does create a very short-term settling effect when shippers start to execute on new bids as carriers are repositioning equipment. Some of that might roll out to spot for a short period of time, but until the carriers get their contract legs underneath them and get that consistency on those lanes.
Okay. All right. Good stuff. Thank you. So let's bring Dustin back in. Dustin, Wall Street Journal reported this morning lumber prices tumbled 27% since March. Love to get your take on what this tells us about demand for things like residential construction lumber that a lot of flatbed carriers haul to various markets. What's your take on that?
Yeah, I mean, we were pretty constructive on the demand outlook this year. We were, kind of pointing to the big picture of things being, trending up. And to start the year, it did seem like that was the trajectory, but things are really showing signs of decelerating in the sort of residential construction market, particularly in on the single family side, right, which is sort of the larger source of building materials demand compared to, say, multifamily, right? For lumber anyway, you use 3 to 4 times more lumber in a single family unit compared to a multifamily unit, right? So we were seeing a good sort of reacceleration in single family housing starts, end of last year, middle of last year into early this year, but things have really lost steam there. I think part of the story is housing affordability, especially for prospective home buyers, really still seems quite dire, right? The Fed hasn't really cut rates. It's still taken sort of a hawkish tone. So interest rates are still high. So I think a lot of those kind of more qualified or able buyers, that pool is starting to dwindle a bit. And there's kind of some cracks in the discretionary consumer too, and that's going to affect home buying. So that is kind of the impulse. We're losing deceleration on the demand side, and then just other categories have been super weak as well for consumption. I mentioned multifamily. We know the story there. Apartment construction, at least for starts, has really turned over pretty dramatically compared to the soaring levels we were at, the last year or two. And then the repair and remodeling side is a piece too that is often forgotten in the sort of residential construction space. For lumber, that's over 40% of consumption comes from repair and remodeling, and that category has been really kind of sluggish based on the indicators we follow in our own proprietary sort of measures of that market. If you've kind of followed Home Depot and Lowe's earnings reports, that gives you a little bit of color there. So there's really, the one impulse for demand growth reacceleration, single family is losing steam again, and that's directly feeding into lumber and broader wood products prices right now.
Yeah, because that affects not just flatbed carriers, but also dry van carriers in our market as they haul finished goods for residential construction like carpets and electrical appliances. So there's a real flow-on effect there. Certainly not good news. Repair and remodeling, 40%. That hasn't changed a lot. If I think back to we had you on early in the pandemic, I think it was about the same number. So does it sit about 40% consistently?
Yeah, exactly, Dean. Based on our sort of measurement of it and our assessment, it's a little over 40%. It shot up during the beginning of the pandemic. It shot up to say 45, 46% because there was such an outsized amount of renovation and home improvement activity. And also there was a temporary pullback in new construction too. So, new construction pulled back, but everyone was stuck at home, based on all the things that we talked about with pivot from the service side of the economy to the goods side of the economy and all the fiscal stimulus that was pointed at households at the beginning of the pandemic. Right. So we did see a jump in that share, but it has sort of reversed now. Part of that being, again, the pivot, from goods back to services as the service economy is reopened. That fiscal stimulus has sort of worn off. And there's also, arguably some pull forward of projects, right? People did projects in 2020 and 2021 that they probably would have done that in 2022, 2023, 2024. So if you put in that deck, you put in that fence, you put in that shed, it's kind of cannibalizing demand today, right? And I think between that and also just a more careful, there's clearly more caution with consumers out there, right? I think some of that, sort of pandemic savings has started to wind down. Job growth is still solid, but it's clearly decelerating. So I think, those discretionary kind of projects that consumers would take on, whether it's contractor driven or their own kind of DIY weekend warrior projects, some of those are starting, are kind of getting sidelined to some extent, right? Or they're kind of trading down to smaller, more manageable projects.
Right.
Hey, Dustin, do you follow I'm sure you do, the source of this lumber from domestic to imports? I used to work for a large pallet company, and we would toggle that domestic or import based on prices and even ocean transportation prices and those sorts of things. Has there been any change in that arena?
Well, so I think the big thing, right? So if you think about North America as a consuming, or let's think about the U.S. specifically. I think it's easier to think about the U.S. For the U.S., around 25% of softwood lumber consumption is sourced from Canada, right? So Canada for softwood is a really big supplying region. That share has dropped over time just because there's a lot of structural factors with timber availability, especially in Western Canada. A lot of it has to do with a pine beetle infestation over basically a decade and a half, or almost 2 decades now, that sort of ravaged the softwood resource, especially in the interior part of British Columbia. There's also duties on Canadian lumber, which also kind of can impact supply. But largely the decline has been because of those longer term structural issues. So we are seeing more supply, at least for dimensional lumber, so on grade for framing, particularly coming in from Europe. So you'll see that landed at the ports, Port Canaveral or Houston. That's really where that material tends to sort of be cost competitive. Although right now those guys are not making money on delivered lumber even into those kind of local markets. But that has kind of filled some of the void for some of the structural dimensional lumber that's kind of being pulled out or losing capacity in Western Canada. And you do hear about for more, kind of lower grade lumber for, like you said, pallet and crating and stuff like that. You do hear some of that coming in from, say, Brazil or Chile, some lower graded pine. My understanding, it more competes, it's more competitive in Mexico, right? Which makes sense. It's more, just geographically it's closer. But we do import, some softwood, lumber from Brazil and Mexico for sure. And it tends to be lower graded, sort of material that, like you said, it would be very susceptible to ocean freight rates because, that's a lower price point, lower graded item. So it's going to be more sort of volatile in terms of its competitiveness based on the ocean freight factors. So you do see it coming into the market. It's not a huge factor, largely because there's just so much available southern yellow pine, which is ramping up and is also relatively cheap and abundant, and actually on opposite to the western part of North America, a growing capacity base. So really, a lot of the low grade lumber that we're seeing sort of entering the pallet market, the crating market, a lot of it tends to be southern yellow pine actually produced domestically in the United States.
Yeah, that makes sense.
Dustin, on the imported lumber from Brazil, obviously it comes in break bulk in terms of the import data, as not necessarily, it could be in containers, I guess, but is there a particular port where we're most likely to see that volume?
Yeah, I mean, admittedly, it's been a long time since I've looked at the kind of the U.S. Customs sort of port of entry data. But the last I checked, and just general kind of conversations out in the market, Port Canaveral is really the biggest landing point to your point, like you said, from my understanding, pretty much all of it is break bulk. There might be some exceptions, particularly for stuff that's more, if you're talking more appearance grade, not commodity sort of, lumber products that, maybe a little bit more susceptible to the weather and conditioning, things like that. But yeah, Port Canaveral is really a big one. I'd have to look, Savannah, Houston are also big ports of landing, but Port Canaveral typically is the one that if someone wants to kind of just look at one port and kind of gauge how oversupplied or too much inventory sitting at the port, that needs to move, that's Port Canaveral is the one that you hear most often referenced. So.
I'm just pulling up some data on that right now. I mean, Houston and New Orleans account for about 20% of the break bulk tonnage that come into the country. Cape Canaveral volumes are actually down about 24% year over year. So that's interesting. Logs and lumber are the number 3. I mean, it's mineral oil and petroleum are the number 2 products in break bulk into Cape Canaveral. But logs and lumber represent about 13% of the import volume. They're down 18% year over year.
Yeah. So that makes sense, and what's happened too, right? These European suppliers in particular, because they're really, when you look at lumber imports broadly, and when I say lumber imports, we'll exclude the Canadian imports, so offshore imports from everywhere else except Canada. That's been growing at a very rapid clip over the last 5 to 8 years. So kind of the supply chain in a lot of ways is getting more stretched out to these other sources of supply where there's softwood timber. And really that lumber was landing here competitively for a while, particularly where lumber prices with $1,500, $1,600 lumber prices, you pulled in a lot of offshore supply because, the U.S. and North America was by far the most attractive place to ship your dimensional lumber. But, with prices sub 400 per thousand at the mill level FOB, these European suppliers really are not making any money, even, just kind of, landed at the port. They really need prices to go up another $50, $100 per thousand to be, landing sustainably. A lot of them are still shipping, just because they have commercial relationships they want to keep. If they're, a supplier of Home Depot or Lowe's or some of these other big, builders first source, these big, sort of retailers of lumber. But it's, that's not the pricing environment for not only the import, the offshore suppliers, but the domestic suppliers. It's not a sustainable equilibrium point right now. It's way too low relative to break even. So,
right.
Justin, with hurricanes being a hot topic right now as we enter that season and had our Cat 4 in June, which is record breaking. How does this impact lumber prices if we have a more active season than normal?
Well, this is a great question. And you talk to a lot of people on the market and there's a lot of varying opinions on it. And our general view, just looking through the data, is it's kind of a wash in terms of the impact on prices. And obviously, storm to storm, it can vary, right? Really depends on the path of the storm. And if it really, the storm really hits a couple big epicenters of demand, like a place, a market like Houston or, something like that, it may be swayed more to impacting demand more than supply, but more often than not, it tends to be a wash. Now, where you do see kind of some specific dynamics, for example, up front on the storm, right? There's kind of the boarding up effect, right? Particularly with plywood, so people will go to Home Depot or their home centers, buy plywood, board up, board up the home. So, some of those local markets, you could kind of see some short-term surge pricing a week or, I don't know, we'd have to look at it, but maybe a week or two in advance, as the kind of the storm's path becomes more certain. But, it may sort of goose demand on the on the front side of the storm, but on the back side of the storm, there's no construction happening, right, for a week or two after the storm. And the rebuilding efforts with dramatically impacted markets, right? A lot of it is a function of how fast insurance claims can be processed too, right? And whether these homes are even insured, which is becoming an even bigger question in a lot of these highly susceptible markets, right? So I think it's quite complex what the net effect is, and it really varies storm by storm. But I think in the aggregate, it's usually kind of a wash. And certainly, on the supply side, it impacts supply too, because if you have timber stands that are you have torrential downpours, you can't access those timber stands, right? From a logging perspective, the roads are too muddy. It's a lot of a lot of those areas are inaccessible. So, even if there's kind of an upfront demand shock, even if sometimes, sort of maybe there's a negative demand shock, but then there's another negative supply shock, they kind of balance each other out and prices kind of stay roughly where they're at. So it's often a big talking point in the market, but more often than not, the impact in aggregate, in the big picture for lumber prices is kind of muted. So
right.
That makes sense.
Dustin, maybe one last question as it pertains to interest rates and where things are heading in the single-family housing market. What's your take on where we're at with the Fed and the possibility of interest rate cuts?
Yeah, it's a great question. I think it's really kind of the key factor here that's holding back a more sustained demand recovery. And I think part of our optimism with what we thought would be a stronger demand recovery this year is the fact that inflation is cooling and the Fed would be able to pivot quicker on its rate outlook, which I think, in fairness, we've been pretty we've had a pretty good call on the inflation outlook. It's actually decelerating quite encouragingly based on the latest data. But I think what we maybe missed was the Fed has been still very hawkish and is still being very careful from pivoting. And I think what's happening is it's maybe surprising the bond market to the upside on the rate front, right? So we're still getting these higher, 10-year yields, higher mortgage rates, and that is, slowly starting to erode sort of the pool of demand for single family. So we're kind of getting concerned that the Fed is maybe going to make a policy mistake here, as we're starting to see the construction market really decelerate fast here. So we think that they are going to have to pivot in the months ahead. Our baseline assumption is they're going to have to do at least one cut of the federal funds rate this year. But my concern is that may not be fast enough. That may not be a fast enough pivot, especially if they're hesitant in an election year to cut rates. So I think, for the remainder of the year, it's still going to be painful on the new construction front. But, if they do start pivoting, they're, signaling that they're going to become more dovish, let's say it's September, then I think that will at least set up for a demand recovery, in terms of spurring new home sales, spurring single family construction starts, maybe even bleeding into a recovery in the repair and remodeling market if people can tap their home equity more affordably too for those home improvement projects. But it's kind of leaving 2024 for a wash from a demand perspective, unfortunately. Yeah. But
yeah, that's how a lot of our contacts in the industry and the truckload side see things also. Chad, anything else before we wrap up?
No, I think that's a good way to wrap it up.
All right. Okay. So we'll bring you back in a second, Dustin. Fascinating conversation. We could talk all day about this. I think it's such a good topic as it pertains to demand for dry vans and flatbeds. Our very own Chad Kennedy is on the current Freightvine podcast. He's talking with Chris Kaplis about rate benchmarking. Don't forget DATCon, our customer user conference in Kansas City, October 22 to 24. If you go to dat.com/DATCon before July 3, which would be tomorrow, you can get your early bird registration. New date in for those that are interested. The CVSA is gearing up for its annual Brake Safety Week. That is scheduled for August 25 to 31, focusing on brake lining and pads. Guaranteed that a lot of truckload carriers in the owner-operator small fleet space will take that week off, impacting spot rates and capacity. On next week's show, Paul Brashear from ITS Logistics joins us talking about drayage and intermodal shipping. Dustin, if people want to get in contact with you, what's the best way?
Yeah, you can email me at djalbert@fastmarkets.com. That's probably the easiest way to contact me.
All right, good. Thank you. Great to have you back on the show. Look forward to bringing you back on maybe in the next quarter, and we'll talk more about the lumber market. With that, another show is in the books. Be safe, be nice to everyone. Happy 4th, and we'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific. Thanks, everybody.